A very good evening to all of you, my dear friends. I am very happy to be connected with you through this video lecture. Due to the coronavirus epidemic, we have abruptly ended up our semester days. But however, we, the faculty and the management, was so magnanimous to compensate all the incomplete portions through the videos. I hope you might be receiving these videos from all your subject teachers as well. To start with, as we have been discussing about financial statement analysis for the last one semester, I'm very happy that you have completed two tests and only 1.5 portions or one third of the portions only is incomplete, which I will cover through these videos. Before we get into the topic, I just wanted to give you a brief snapshot of what we have been discussing in the past. We have been discussing on the various techniques and the tools that are available for financial statement analysis. Can we just recollect that? Number one, comparative financial statements, common size financial statements. Number three, trend analysis. And number four, ratio analysis. I'm sure you are very much comfortable in all these areas, and to prove that competency, you have done your internal assessments as well. Today, in that series, the fifth important techniques in financial statement analysis is cash flow statement. What exactly we mean by this cash flow statement? At this juncture, I request all of you to keep the PowerPoints which I have shared in the Google Classroom few days before. I'm happy that few of our students are responding to my queries and remarks, and even I'm very happy that they are submitting the assignments through the Google Classrooms. If you have not joined, I request that you immediately do that so that we all come in one platform to get the concepts to our knowledge. Because I wanted to tell you here that I am including these portions which I am going to tell you in the next few days through these videos for setting question papers for the final examination. Right. So to begin with, what do we mean by cash flow statements? First of all, what are all cash? What is meant by cash? Cash refers to cash in hand, cash at bank, and all cash equivalents. What is this the term refers, the flow refers to? The flow refers to the change. So any statement that is prepared to depict the changes that has happened in the cashes or the cash or the cash equivalents is called as cash flow statements. Hope you understand it. It is a statement that depicting change in cash position from one period to another period. If you take the example of a balance sheet, we call it as a static statement because balance sheet does not reflect any changes that has happened over a period of time. It doesn't compare with that of the previous years. So this cash flow statements overcomes the limitations of the balance sheet and enables the top management for quick decision making to understand where this cash comes from and where this cash goes out. For example, if the cash balance for 2015 happens to be 30,000 rupees and the cash balance as on 2016 happens to be 40,000 rupees, So then it is inferred that there has been an inflow of cash to the tune of 10,000 as compared to the previous year. So this kind of a statement which expresses or which brings out the flow that takes place over a period of two balance sheet dates. So therefore, a cash flow statement is clearly understood as a statement that depicts the changes that happens in the cash and cash equivalents. Today, every enterprise has been mandated to prepare cash flow statements for each financial period and along with the income statement and balance sheet. The preparation of cash flow statements are today governed by the accounting standards of the Institute of Chartered Accountants of India, and we call it as IND AS, that is Indian Accounting Standard, which is almost equivalent to the IFRS, the International Financial Reporting Standards. What are the objectives of these cash flow statements? First thing is to help in short-term planning, particularly ensuring the liquidity of the firm. For any firm for that matter, liquidity is one of the very important things. The term liquidity I have already explained to you during the class time, that as company is expected to keep adequate cash to meet their day-to-day operations. And such situation is called a company said to be liquid. And any company is said to be illiquid is illiquid when there is a no cash situation. You take for example, so much of companies has become bankrupt mainly because of no cash situations. So the first objective of cash flow statement is to ensure that it helps in knowing the liquidity of the firm. So in that way it helps in short-term planning. The second objective goes like this: it ensures the ability of the enterprise in generating cash. Once when you feel that you don't have cash, then you have to find out some other objective or for some other ways in order to get how to generate cash for the business. And cash flow statements prompts the management or the authorities to plan in that angle also. And finally, the third objective is it helps in preparing the budget forecasts every year. Only when you know what is the cash status or cash position that you have right now, it can be enabled that the next 1 year's plan of operations can be planned, or next 5 years down the road. Suppose if a company has any expansion plans or any modernization plans, definitely it needs cash. So with the present situation, how can you barge on to this future expansion or modernization? And how can you prepare a budget forecast? This is enabled once when you know how to prepare a cash flow statement. What are the benefits of these cash flow statements? The objectives are very clear and the benefits are also very clear. Now I'll tell you what are the benefits that we derive from these cash flow statements. Number one, helps in efficient cash management. Cash is all the basis of the operations. Today in business, everything eventually boils down to a rupee sign. For example, you need cash to buy raw materials. You need cash to pay your employees. And you need cash to sell even your products. So all these areas ultimately boils down to a rupee sign. So you need to manage efficiently, otherwise it will be a very disastrous thing. Take for example the story of Kingfisher Airlines. What has happened? It is a complete mismanagement of cash, which is supported by ill-drafted strategies of the company. So completely the company has been vanished. They had a huge amount of debts borrowed from banks, but ultimately they didn't channelize their revenues to repay their debts. Ultimately, mismanagement of cash took place and the company went into bankruptcy. Similarly, next in the line, the Jet Airways. They also had a problem like this, and finally their cash out situation came in, and they also have been now completely knocked out. And third in the line, Air India. So all these companies, if you see the stories, completely everything eventually boils down to one particular scenario, that they all are faced cash out situations. So you have to, as a manager, efficiently manage your cashes so that it is giving you uninterrupted operations the company expects. Secondly, the benefits of the cash flow statements are, it provides information on the availability of cash. It tells you, it forewarns you, okay, this much of cash is available. So what can we plan? And secondly, it helps enterprises about repayment of borrowings. You may have already got a huge amount of debt, and it is your duty that you have to repay over a period of time. Whether you have sufficient money to pay your EMIs, whether you have sufficient money to pay your interests, and all these things has to be addressed only when you have a very pakka internal financial management scenario. And secondly, if you have a commitment to your shareholders for payment of dividends, then it has to be allocated upon. You have to find out efficient cash and allocate it so that it is easy for you to discharge your responsibility to your shareholders by giving them the dividend on time. Otherwise, it will have its repercussions that the shareholders may be unhappy and they may have to leave the company when you are not paying their dividends on due time. And finally, it is not always better that you keep on with old machineries. You may have to invest on new machineries, new technologies for which you need cash. So you have to plan well ahead of time, and you need to know where from I'm going to regenerate my cash and how I'm going to buy these new machineries or new technologies. So only when you keep moving, then your operations or your sustenance will be assured. And the third point, cash flow statement helps you to predict the corporate failures. For example, if the enterprises fails when their inflows and outflows does not match. What do you mean by this? The Reserve Bank of India has given us directions that if the current ratio of the company, which is all used by us in the classes, that we said 2:1 is the mandate or is a thumb rule. And when the company is not able to maintain its current assets of 2:1 for the last 3 years, then it is an indication that the company is sinking, or the company is said to be sick, and ultimately it will become bankrupt. So the predicting the corporate failures is possible through your cash flow statements. Ultimately, when your inflows and outflows do not match, and particularly when outflows are more than your inflows, so you are sure that the company is going to sink. And finally, it also helps in examining the profitability, the net cash flow, and changing prices. Normally, for any company, revenue from the sales is the only source they get to as a cash inflow, and their profitability is of much concern. So I have already told you the difference between a profit and profitability. That means profit is the ultimate factor, which is the excess of revenue over expenditure, whereas profitability is the efficiency of the company to make profits. So you have to understand the efficiency of the organization. Where is the leaking takes place? Where is the gap? And ultimately, when you check that gaps, automatically your profitability starts increasing. And once when its profitability increases, your net cash flow positions also increases. So we have seen about today the various objectives, or what is cash flow statement, and what are the objectives of a cash flow statement, and what are the benefits of cash flow statements. I will come back in another video to explain to you the other important intricacies that are involved in cash flow statement. Thank you very much. We'll meet the next video. Thank you.